Okay, hello everybody, and welcome back to, I believe this is the sixth episode of the Small Town Housing Show. It's been a very interesting week in the real estate markets and in the news headlines. It is April 4th, the day that I am shooting this. Before I give you guys a rundown of the show, I'm just going to say quickly, at this point, it seems like it's safe to say we're going to be able to launch these on Wednesdays. I'm trying to shoot them Sunday, Monday, or Tuesday. And so we're going to try and stick with a consistent release date of Wednesdays. So can't guarantee a time, but that's what we're shooting for. Let's take a brief look at the summary of what we're going to talk about here this week. We're going to go over the 7-day statistics. I'm going to also mention the 3-day. We're going to look at some macro news, some headlines here in the province about some regulatory changes. We're going to talk about interest rates. We're going to talk about the bond market. We're going to do our sentiment watch segment because that one is really a sort of a leading story here. We are going to talk a little bit about what's going on in Toronto. The Toronto Watch is definitely relevant this week. And then we're going to just hit quickly on some buyer perspective, seller perspective right now. And then we're going to wrap things up. So for those who are new to the show, I'm Mitch Cleary with Century 21 and the Cleary team in Peterborough. If you guys want to find us, all my social links are always down below. And like I said, we're putting out stuff weekly, and feel free to reach out to us if you're looking to do anything in the Peterborough area. Also next week, we're going to have our second guest, and you guys are really going to enjoy hearing from Garnet Northey. He is the president of the Peterborough Kawartha Home Builders Association, and he has massively valuable insights and opinions into the supply chain bottlenecks and red tape, specific stuff about the red tape that builders face and that are hindering the supply side of the equation on our real estate markets and our affordability here. So watch out for that next week, Garnet Northey. And without further ado, let's get into the discussion for this week. So the 7-day review really took me by surprise. Just every week before I shoot the show, I'm going back to the last 7 days of activity to sort of break it down into these micro chunks so we can get ahead of trends as they're happening or sort of watch them evolve and unfold. And last week, 83 new listings, 71 firm sales. Seasonally, accurate amounts of activity, very high, but only a net of 12 new listings. If you've been following week over week, we're looking at more close to 20 in the last couple of weeks. So this has already sort of gotten back down to indicating, hey, the buyers are still coming in volumes that are keeping this inventory low. So when I look at the 3-day, because we're really starting to feel a shift, and that's the most sort of overwhelming note right now, is that in the 3-day, 43 new listings and 26 firm sales. So that's just in the last 3 days alone, a net of 17 new sales coming on. And I would say that's abnormal because the last 3 days right now are only capturing Friday and the weekend. And that's not a time when a lot of new listings are prone to coming on. So I'm going to jump ahead on the stats note real quick to what is happening because our monthly statistics, this is the start of the month. March is not totally tabulated yet in a format that I can really break down and dive into with you guys. So that'll probably be a little bit of the intro to next week's show. But what I can tell you is that surprisingly, against the odds, against what I would have thought, is that our market price-wise, average price-wise, is up fairly significantly, roughly 3% month over month. We had a very strong start of March, and the second half of March really seemed to tail off, where a lot of new inventory coming on and the bidding wars getting watered down. We're seeing a lot of cancel relist happening out there, where a lot of people are missing their offer dates. It's starting to the shift is definitely in full effect here in our Peterborough County and our Peterborough area. And just a quick note, months of inventory. It looks like the months of inventory for March is hovering around 0.6, which is actually down just slightly from February, which again amazes me. It shows how really quick and crazy things were at this very start of March, because things were so different in these last couple weeks that I think we're going to really see a change in April's monthly statistics and week by week right now, really feeling that there's going to be a change happening and more inventory, the months of inventory rising, the total supply rising. So on to the macro news, really interesting storyline this week and the past weeks is that the fixed mortgage rates are rising really rapidly. We're starting to see 5-year fixed product over 3.5%. I'm even hearing that there's some 4% numbers out there at some of the big banks. And this really was fascinating to learn about why this is happening. And I really got schooled on this week and had to dig deep into understanding this. Is that essentially the fixed mortgage rates are more or less dictated by the government bond yields, so the 5 and the 10-year bonds. Because when you think about a bank, if you're going to lend out mortgage money, when you look at the risk profile of lending a mortgage to somebody and the rate of return you're going to get, it sounds like the banks are always pegging these rates just 100 to 200 basis points above the 5-year Canadian Treasury. So that's the bond is issued, a 5-year government bond is issued, and at the time of its issuance, depending on the price that they go out at, there's a fixed rate of return. So it's as simple as, just to give you a scenario, say the Canadian government issues a bond, and at the date of issuance, that it's going to pay you in 5 years $1,000, and the issuance price that it goes out at is $900. So you're buying a contract that the government's going to basically give you all your money back plus $100 in 5 years. Now, those notes get traded on secondary markets throughout their lifetime, leading up to their maturity, when that $1,000 is going to be paid out. At certain points in their lifetime, they might trade at $950, where someone's only going to make $50 when they receive it. And at certain points in their lifetime, they might trade lower, down towards $800, which would mean that the effective rate of return on that bond was higher. And what's happening right now is that there's been a large sell-off in the Canadian 5-year bond. And what that means is that as people are selling it, just like anything, more people selling real estate, the price starts to drop. More people selling these bonds, it waters down the purchase price for all of those buyers out there, because there's less buyers, more sellers. The price of the bond drops. And what that means is that the effective rate of return on the bond goes up. It's very simple. If you buy something that's going to pay you $1,000 in a set amount of years and you pay less for it, it returns you more money as a percentage. So what that does is that as there's been this massive sell-off in the Canadian 5-year bond, that the yield, so to speak, or the rate of return, the interest rate you might equate it to on these bonds, has really shot up. So now the banks are in a position where you say, hey, why am I going to lend a 5-year fixed mortgage out at 2.5% when the Canadian 5-year bond has a 2.5% yield? I'll just put all that capital into bonds. There's no incentive to lend mortgages. It's a much riskier, much more management intensive process. The Canadian bond is essentially risk free. So all of the money would just arbitrage over into bonds as these rates rise if the banks didn't stay ahead of it and factor in more of a risk premium for fixed mortgages. So now you have it. The bond yields have shot through the roof in the last couple months. Fixed mortgages have followed in kind. They've stayed ahead of it. So we've got the 5-year fixed mortgage is the gap, the spread on the variables is huge. As far as I'm aware, at this current date and time, people are still getting closer to 2%, just under 2% on their variables. There's an interest rate announcement coming up, I believe, on April 13th from the Bank of Canada. Pretty much certain it's going to be half or 25% basis point rise. Could be more. The Federal Reserve is signaling that it's going to be 0.5% at the next meeting. So the variable rates are really starting to rise now. So what we've got is that the private market has moved on their own, everybody's selling off bonds for whatever reason. We could dive into that. That's a whole other topic of why this bond sell-off might be happening. Inflation is definitely one big thing, but the risk and the unpredictability of the next short term in our economy here is another one. But there's a lot of things happening with interest rates now. So the 5-year fixed is shot right up. Everyone's going to be getting herded in towards these variable rates, and the variable rates are on the move rather quickly as well. So the cost of money is going up. People's ability to lever themselves is going down. So let's jump quickly here too, because obviously that is a whole tangent, guys, the cost of money that we can just keep going down into. The picture is clear that people are not going to be able to continue to stretch themselves as far as they have over the last couple of years at these record low rates. And of course, the implications or what is likely to happen with prices is obvious. Now, let's go on to the provincial headlines. So Doug Ford, they're coming out with this, this housing task force. There's a series of headlines that have come across. Just when I go up and Google, Canadian real estate headlines, splashing headlines out there from a lot of the major news outlets about right as interest rates ratcheting up, provincial government piling on, basically all factors are descending on stopping this housing market. And when we look at what has actually been proposed by the provincial government in terms of their new measures, I'm just going to hit on a couple of them. I really glanced over this and have had conversations on the peripheral with people about it who have been tracking this stuff. We had a great meeting last week in Peterborough, held by the Peterborough County Association of Realtors, where there was city representation and county representation from the planning departments about what's going on, and some really great insights about the interactions between the provincial and municipal governments. But in regards to Doug Ford's most recent announcement, it sounds like they're planning on putting on deadlines for approval turnarounds, or else you'll face fines. So this is kind of like the you get your pizza in half an hour or it's free. The provincial government is basically trying to impose this type of deadline on the municipalities, which is difficult because the municipal budgets, the municipalities are on their own in terms of their finances. They're not interrelated with the provincial or federal funding. The municipalities have to raise their funds on their own. It's in large part from the property taxes, but their ability to scale up their talent, their ability to hire, train, and expand their capacity to process new permits it's not the most elastic process in the world. It takes some time. So I mean, hey, obviously, I don't think it's going to hurt that they're trying to speed up these deadlines. But I mean, the municipalities have known for a long time they've needed to do this. So it's going to be interesting to see if there's any real change or if they actually start fining these planning departments if they don't get applications back in time, and how serious the fines will be, and then what the follow up from that will be. Arguably, though, a lot of the counter arguments coming up is that it's not just purely the time, not purely the speed of the turnaround. It's the lens through which these the approvals are analyzed. So it's not just the speed of turning around the ones that will be turned around. It's expanding the scope of the ones that will be turned around, aka freeing up a lot of the locked up Ontario lands and removing a lot of the sort of not green bottlenecks, so to speak, but preservation, big blobs on the maps that are not able to be developed, or severances aren't allowed to be approved. So in short, quicker times, but still the same amount of land is going to be locked away. And a really interesting point from the meeting last week there at the Holiday Inn that the Peterborough County Association of Realtors, which hat goes off to them, all the folks there that put that together. That was fantastic. Basically, a really interesting insight about density requirements and how they're trying to really push the envelope on densities is that of course, it resonates with the mid-sized cities like Peterborough, but when you talk about the peripheral towns, like Cavan, South Monaghan, Lakefield, all these smaller jurisdictions, the density, there was, Ian Mudd brought up a fantastic insight last week that the ability to go even mid-rise is really hampered in the peripheral areas outside of these mid-sized cities, because the fire forces are primarily volunteer, if not exclusively volunteer. So there is a resistance to go above a few stories. So your ability to really capture and take advantage of your existing infrastructure and your prime planning around your central hubs instead of sprawling out is hindered or limited by your ability to scale up your fire manpower and equipment. So there's still some really down at the municipal level. The province is coming over with some heavy-handedness here, but it's not going to be a magic wand. Interestingly enough, the CBC came across with their article really attacking Doug Ford on some of this stuff. All talk and nothing's going to happen, and I found that interesting because the more that this whole situation has played out over the last couple of years, and it's been brought to light in many of an opinion now that the CBC really is a trumpet for the current acting government, and that they seem to have a mandate to thwart any other message that doesn't support the current empowered party. I just thought, hey, here you have a mess. Finally, the province, and Doug Ford, from the blue side of things, coming across with, we're trying to do some stuff here. And of course, at any message, we can poke holes in how much it's actually going to grab traction. But wow, I found that article was really malicious towards Doug Ford and how they're not going to get anything done, and he's just going to try and protect himself leading up to an election. Nonetheless, that will be yet to be seen what's going to happen there. But the news headlines, the headwinds are that the government is definitely they're having to come over with these announcements to cool down people's fears, and arguably they're doing it right at the wrong time. The interest rates, the cost of money is doing a lot of the work here, and the provincial government here coming in, probably too late to the game, but not that they've really pulled any super meaningful levers yet. Also, there was an increase in the foreign buyers tax, I think of around 5%, and a lot of people, of course, speculating right away how quick these taxes can just be skated around, and they're not super meaningful. They're more just to shift sentiment. So on to the Toronto Watch. I'm going to pull up a screenshot here of a very interesting tidbit I'm following several good GTA realtors I'll give a shout out to here. Daniel Foch is one, Nazma Ali, always putting really good stuff up about what's happening down there. And it sounds like a lot of cancel relists, a lot of price changes. So one from Nazma Ali here, 1,022 houses for sale in the GTA with price change status. That's a lot of price changes, right? Relatively speaking, I think last week here in Peterborough, I missed this section on the 7-day, we had 10 price changes. So relative to the amount of activity, it's about the same as what we've seen in the last couple of weeks, but it's more than what we've seen in the earlier parts of the year. It means these cancel relists are happening. Don't get any offers on offer day, cancel relist closer to market rate. But it's happening a lot in the GTA. And I'm going to share, this was a retweet from Nazma Ali by Can Indian Bro. So this is a Canadian Indian gentleman who's posting a lot of stuff about what's happening down in the GTA. It's more on the journalism front. I don't believe he's actually a realtor. But he posted a good bit from using House Sigma, posting some data about a sale in the GTA that a comparable just several weeks ago sold for, I believe it was a couple $100,000 higher. So clear evidence that the prices are slipping and that the peak has been reached in the GTA. I'm going to share that for you somewhere here so you guys can have a quick look at it. Moving on, sentiment watch here locally. Do feel definitely that a lot of sellers are feeling the pressure. Of course, it resonates really quickly when some sale prices that are being realized right now are much, much different than they were just 3 weeks ago. And then the rush is on. We're really sensing, it feels that this spring is a little bit different than that inventory flush that came through in the last couple of years in the spring that cooled down that seasonal, that real frenzy that was happening in the winter when the inventory was so tight. This year seems to be a bit different because, of course, all the macro headwinds are saying that are pointing towards that the recent rampage can't be sustained. So I would say that people seem to be more anxious, sellers more anxious to get their properties on quicker, and that buyers are, as the headlines start to come across here about how the prices are changing, buyers, of course, are becoming a little bit more patient. So buyers, in terms of now just the last couple notes here, buyers and sellers' thoughts. Realistically, whether or not right now it makes sense to rush and get your house on the market and try and realize these prices, it totally depends on what your long-term plans are. I don't like this viewpoint of, if this is your primary residence, you just jump off because we're at the top of the graph and then you figure out the rest of your life later. If you have kids and a family, people who think that they're just going to sell and realize this amount of money and magically the rest of their life's going to figure itself out, that doesn't, it's quite a bit of term. I did it in 2017, sold my primary residence at what was the perceived peak at the time it was. And we had a pretty good go of it all in all, but we at the time only had one child and it was a lot of work, just hustling around, renting for a year, trying to find a place, struggling to find deals, eventually bought a lot and built. But man, what a ton of work. You're putting all your eggs in that basket. And if you don't make a real amount of money that's going to change your life, because if things don't continue to go down and you don't buy back in at a cheaper price and you've done this whole shuffle just to make a few bucks, it's not good. So I'm just saying is that if you think you want to sell right now, really decide what your reason is, because yes, it seems that there's clear momentum towards that. The prices are going to be going down right now faster than they're going to, more likely than they're going to be going up in the short term. But beyond 6 months, our ability to predict is just so hampered by the amount of things that can happen in the global markets, and really what our government decides to do. Because, of course, as interest rates continue to rise, so many different things are going to happen with the financial markets. So many different things are going to happen globally. Again, I'm going to point to Steve Saretsky and the Looney Hour podcast. They've done such a fantastic job of outlining some of the macro insights that are out there right now. And one of the best ones, I think, is that what might happen is if these interest rates continue to rise as rapidly as they are, is that the emerging markets might have some real troubles. And I can see how that makes so much sense, is that if the Canadian bonds and the Canadian overnight lending rate is raising from, basically zero up to, you start to see 2-3%, what does that do to new debt issuances in emerging markets, third world countries, where they're much riskier, much higher chance that they won't repay? Now, all of a sudden, they're in this same sort of bubble where they're having this inflationary, not enough production in their economy, too much debt. The only way to do is keep expanding the money supply, just inflate, and keep paying off bad old debts with more new money, more new debt. And then all of a sudden, when they can't issue, when they're not having new debt issuances go according to plan, when people are saying, no, I'm not, we're not buying these bonds at a 5% return anymore. We want 10, because relatively speaking, why would I buy these third world emerging market government debt at a mid-level price when the first world country debt is so close? It's going to move everything up, and the money is going to get more expensive for these third world countries that a lot of them are in precarious situations. I just heard a headline this morning that there was revolt, I believe, in Sri Lanka, really mass the government trying to clamp down on communications and everything of the people because there's such economic struggle going on there. So really, we don't know how much these rates can continue to rise before all sorts of bad things happen globally that could basically pull our government back into a bit more of a, we'll keep these rates lower for longer approach. Of course, our own inflation is the main thing hindering that, but we still could see a bit more of a cautious approach going forward as things start to, as Steve Stresky always says, as things start to break. And you can really visualize it. You can imagine so many ways right now that things could, quote unquote, break as the cost of money continues to rise. So that's it for this week. Look out for Garnet next week. It'll be another long format interview. I think it's going to be packed with value. I'll get you guys caught up a little bit more on how the stats for March tabulated. At a glance, they turned out much stronger than what we thought, which is a testament to how strong the first 2 weeks of March were, because we've really seen a different story in the second half of March. And that's it. Contact us. If anybody out there is watching and you're looking to buy or sell in Peterborough, again, I'm Mitch Cleary. I'll attach my email is down below, team website, and we're happy to help or have an initial consult with anybody who's looking for some forward guidance about what to do right now. So thanks everybody for tuning in, and we'll look forward to catching up with you again next week.